Vietnam's economy continued to show solid momentum in February, despite a more uncertain global environment. One notable development came from trade policy. U.S. tariffs on Vietnamese imports have declined to an effective rate of 18.8%, down from 21.6%, following a policy adjustment after the U.S. Supreme Court invalidated the Trump administration's global tariff measures. During the month, Vietnam's General Secretary To Lam also met with President Trump, with both sides agreeing to intensify trade negotiations. On the sidelines of the visit, Son Phu Quoc Airways signed an agreement with Boeing for 40 aircrafts, while the U.S. signaled it may reconsider restrictions on Vietnam's access to advanced technologies. Meanwhile, Vietnam's manufacturing sector strengthened further. PMI rose to 54.3, the highest level in 4 months, reflecting stronger production and new orders. This momentum was also visible in trade, with exports growing 18.3% and imports 26.6%. Although Vietnam recorded a temporary $3 billion trade deficit, which we expect to return to surplus in the coming months. Domestic demand was more mixed. Retail sales growth moderated to 7.9%, suggesting consumers are more cautious than previous Tet holidays. However, tourism remains strong, with international arrivals reaching 4.7 million, up 18.1% year-on-year. At the same time, the labor market started the year on a positive note, with around 300,000 new jobs expected in the first quarter and wages projected to rise about 4%. Investment activity also remained supportive. FDI disbursements reached $3.2 billion, up 8.8% year-on-year, with over 80% directed to manufacturing. Public investment continued to accelerate as well, increasing 11.5% year-on-year, supported by infrastructure construction even during the holiday period. Major projects such as the Can-Tho-Cau-Mau Expressway and Ben Loc Long Cai Expressway are expected to be completed in early 2026. February inflation was 3.4%, mainly driven by higher food and housing-related costs during Tet, while transportation costs declined. However, the Iran conflict could raise freight costs and oil prices, adding inflationary pressure. Vietnam's direct exports to the Middle East account for only about 2% of total exports, limiting direct exposure, though longer delivery times and higher shipping costs may affect exporters. Vietnam operates 2 oil refineries, Binh Son Refinery (BSR) and Nhi Son Refinery (NSR), which together supply nearly 80% of domestic gasoline demand. BSR mainly processes crude oil sourced from domestic fields, limiting its direct exposure to Middle East disruptions. Meanwhile, NSR has secured sufficient crude supply to maintain operations through the end of March 2026, supported by existing inventories and shipments already in transit. Given the uncertainty surrounding the conflict, we will continue to monitor developments and assess their potential impact on Vietnam's economy. Vietnam's stock market continued its upward trend in February, with the VN Index rising 2.4%. The market initially fell about 4% ahead of the Tet holiday as investors reduced leverage before rebounding afterward. Liquidity remained strong, with average daily trading value reaching $1.3 billion in the first 2 months of 2026, more than double last year. However, foreign investors recorded net outflows of $301 million, including a $81.8 million divestment of Jardine Cycle and carriage from Vinamilk. In terms of sector performance, real estate led the gains, mainly driven by Vingroup, supported by reports of a potential IPO of its ride-hailing unit, GSM, in Hong Kong in 2027. Other residential developers, however, faced pressure as rising mortgage rates raised concerns about softer housing demand. Energy and materials also performed well. Binh Son Refinery surged 39%, supported by capital inflows following Resolution 79 on the role of the state economy and expectations of higher oil prices. Meanwhile, Ho Fat Group took the lead in materials sector, gaining 7%, supported by expectations of stronger steel sales and improving profit margins. On the other hand, the technology sector lagged, with FPT declining amid foreign net selling and concerns that artificial intelligence could disrupt outsourcing demand. In our view, this reaction may be overstated, as productivity improvements from AI could enhance efficiency and potentially expand demand. At current levels, the stock is trading at around 15.1 times 2026 forward PE. Another key development investors are watching is Vietnam's potential market upgrade. FTSE Russell will announce the result of its review on April 7th. After concerns about foreign investors' access to global brokers, the Ministry of Finance issued Circular 08, allowing foreign institutions to trade through global brokers without opening a local account. With this issue addressed, the probability of Vietnam passing the review now appears high. Our portfolio rose 0.3% in February compared with a 2.6% gain in the FTSE Vietnam Index. Year to date, however, the portfolio is up 7.3%, well ahead of the index's 1.2% increase. Going forward, we expect higher market volatility amid geopolitical uncertainty and a market still dominated by retail investors who account for more than 80% of trading activity. That said, Vietnamese listed companies have limited direct exposure to the Middle East, meaning any impact would likely come through higher input and logistics costs. Meanwhile, valuations remain supported by fundamentals, with the VN Index trading at around 14.7 times forward PE and earnings of the top 100 companies expected to grow about 14%. Progress toward a potential emerging market upgrade could also provide further support to market sentiment.